It didn't explode overnight. It accumulated quietly until one day, a single company started feeling too big to be neutral. A firm most people had never heard of was suddenly being treated like a political force, not just in finance circles, but in state legislatures, cable news, and culture wars it never asked to enter. The company was BlackRock. Its rise began with a simple shift in global money management. Index investing was supposed to be boring, even invisible. Track the market, reduce costs, step back. But scale changes perception. As trillions moved into passive funds, ownership concentrated quietly in a handful of institutions. By the time the 2008 financial crisis hit, BlackRock was no longer just another asset manager. Governments needed help untangling risk on a massive scale. Suddenly, it wasn't just tracking markets, it was analyzing and managing the system itself. That role expanded its reach deeper into the foundations of global finance. Then came the second shift: corporate influence. Through its index funds, BlackRock became one of the largest shareholders in thousands of major companies. With that came expectations about governance, climate risk, and long-term strategy. Under CEO Larry Fink, annual letters to executives began emphasizing environmental, social, and governance considerations. To supporters, it was responsible capitalism. To critics, it looked like private power shaping public policy. That tension was the trigger. As ESG became politically charged, BlackRock stopped being seen as just an investor. It became a symbol. In some states, politicians accused it of pushing ideology through capital markets. Energy-heavy regions began questioning contracts and threatening divestment. Suddenly, a firm built on diversification was being treated as a single ideological target. The escalation peaked when finance and identity politics fully merged. The same infrastructure that made BlackRock efficient, its scale and passive ownership, now made it feel unavoidable. Critics argued that no single institution should hold that much influence over corporate America, even indirectly. Inside the pressure, a pivot emerged. BlackRock began adjusting its public language around ESG, emphasizing fiduciary duty and client choice more explicitly. The goal wasn't retreat, but recalibration, reducing the perception of ideology while preserving its core investment model. The key moment wasn't a collapse or reversal. It was validation under scrutiny. Despite political backlash, capital continued flowing in. Institutions still relied on its systems. Governments and pension funds still used its infrastructure to manage long-term savings. The original problem, how to efficiently manage massive, fragmented global capital, was never fully solved in a dramatic way. Instead, it was absorbed into everyday financial infrastructure. And that is exactly what made it controversial. Because when something becomes essential enough, it stops looking like a company. It starts looking like power itself. Question for you: what do you think about BlackRock? Would you like to work there?